Imagine waking up, opening your portfolio, and seeing almost every dividend stock, Coca-Cola, Pepsi, Procter Gamble, Philip Morris, Altria, all trading lower. The first thought that comes to your mind, is the consumer staples sector crashing, or is this the perfect buying opportunity? Today, we're going beyond the headlines to uncover the real reason why these dividend giants fell together. Let's answer the biggest question first. Is the consumer staples sector crashing? The answer is no. Most of these companies declined by less than 2%. That's a normal trading day, not a market crash. A true crash usually means 5, 10, or even 20% losses driven by panic selling. Today's move doesn't fit that description. The number one reason behind today's weakness is rising U.S. Treasury yields. When bond yields move higher, investors suddenly have another safe place to earn income. Many investors start asking, why take stock? Market risk when government bonds pay more. As a result, money flows out of dividend-paying stocks and into bonds. That's why Coca-Cola, PepsiCo, Procter & Gamble, Philip Morris, and Altria all fell together. Wall Street is always moving money. Today, investors shifted capital from defensive dividend stocks into growth sectors, especially artificial intelligence, technology, semiconductors, and other high-growth companies. This process is called sector rotation. Markets are also worried that interest rates could remain higher for longer. Higher rates increase borrowing costs, reduce stock valuations, and make dividend stocks less attractive compared with safer investments. Even great businesses can see their share prices fall because of this macroeconomic pressure. Are these companies in trouble? The answer is not really. Nothing major has changed about these businesses. People still buy Coca-Cola. Families still purchase Pepsi products. Consumers still use Tide, Gillette, and Pampers. Philip Morris and Altria continue generating strong cash flow. Today's selling was driven far more by the overall market than by company-specific problems. History shows high-quality dividend stocks often decline temporarily when bond yields rise. Long-term investors sometimes use these pullbacks to buy great companies at more attractive prices. But remember, always check earnings, cash flow, debt, and dividend sustainability before investing. So, is the consumer staples sector crashing? No. Today's decline was mainly caused by rising Treasury yields, higher interest rate expectations, investors rotating into AI and growth stocks. The businesses themselves remained fundamentally strong. Now it's your turn. Would you buy Coca-Cola, Pepsi, Procter & Gamble, Philip Morris, or Altria after today's pullback? Let me know in the comments. If you enjoyed this analysis, please like, subscribe, and turn on the notification bell, because here we don't just report the market, we explain why it moves.